Welcome back to the Stock Estate, everyone, and today we are talking about growth stocks. Okay, I absolutely love the feeling when, I get into a company that has really, really solid fundamentals, that is backed up with numbers and the stats and the sales, and, I get in before everyone else, just like how I did with NIU and Teladoc. And when it starts running up, okay, everybody's chasing the hype, okay, but I'm just sitting back there, after doing my research. And as everyone pour in their money inflow into the company, okay, I'm getting all the early mover gains. And that's what I love about, getting early on this kind of growth stocks. And today's topic will actually be about a best small cap growth stocks that is out there that I'm recently, been discovering, and I feel that there's massive potential, for this company, and especially when this company's total addressable market is really, really in line with what I believe that it will grow to be. So yeah, and for my channel, if you don't know who I am, okay, I'm a former financial advisor, and this channel I do tutorials, I do swing trade picks, I do long-term growth winners, which is what this channel or this video is what I'm doing today. And yeah, again, as I said before, I give a very unbiased view on companies. I don't just talk about the good sides. I do talk about their risks as well. Okay, just like how I did with GME. Okay, I made a video about GME. Okay, you can go check it out. Okay, not a lot of people some people were not really happy about it, but I do give my honest opinion about what my opinions are, and you should take it as like a second opinion about things. And yes, so today this company, okay, I will talk about its risks. Then, I'll talk about its bull points. So stay with me, and I'm pretty sure you will get a lot of good information from this. So firstly, okay, this company, right, the risky risks. Okay, so it is a penny stock. Okay, and what's the definition of a penny stock? Okay, penny stock is okay, some people may define it differently. Some people may define it as a company which the stock price is less than $5. Okay, some may define it as a company that has a market cap of less than 1 billion. Okay, for me, it's not really about the stock price itself, but this company does have a market cap of lesser than 1 billion, which is around $700 million in market cap, which in my opinion makes it a small cap come penny stock. And most of the time, I really, really do not like penny stocks, okay, to be honest. Even as a swing trade, okay, because it moves so volatile, it moves so much in one day that sometimes you just get stopped out, or you just don't, it's very hard for you to, capture profits unless you are really, really sticking to the markets and looking at this company, eyeballing it, from every single minute. So penny stocks wise, okay, have a high chance of losing money. So I don't really actually, go after these kind of companies. But however, most penny stocks, what as I look at is they have a lot of iffy fundamentals. That means they are not profitable, they have no gross margin, they are generally not really very good companies, and there are better companies out there. But this company is a little bit different, and that's why I'm going to talk about it today. Okay, so besides all the risks that I've talked about, right, which is being a penny stock, right, how do I risk manage, and why do I pick this? Okay, so firstly, okay, it has high volume, okay, they have over 500,000 volume per day on average, okay, more than that. So in this case, that means there's still quite a bit of liquidity. There's still buyers and sellers in this stock itself. So we don't have to worry about the bid and ask price being too large and not being able to sell at a desired price. And secondly, right, which is the more important part. Again, as I said, I love the numbers, right. I don't just go into grow place with just no numbers. There's just a vision itself. Okay, I like the solid numbers. So this company has a low risk of going under because it has both quick and current ratio of over 7. Okay, 7. Damn. Okay, so for those people who do not know what a quick and current ratio is, right, okay, just let me give you a quick definition. Okay, a quick ratio is an indicator of a company's short-term liquidity position, and it measures a company's ability to meet its short-term obligations with its most liquid assets. And current ratio is basically this kind of the same ratio as well, but however is the ability to pay short-term obligations within the year. So both of these ratios, right, is a measurement of whether if a company has a lot of debt and they need to cover the debt very, very quickly, are they able to do so? Are they able to pay it with their liquid assets? And usually, right, anything over 1 is good or healthy. That means with any amount of debt, they have the equal amount of assets, liquid assets, to cover it. And this company has 7 times. That means they have 7 times the assets to cover their debts or liabilities. Wow, okay, that's so much cash on hand. Okay, so in a sense, really, I'm not really too afraid of this company going under for the short term to mid term wise. So this gives me a second, like a ease factor, especially when I'm going looking at this as a more fundamental long term position that I'm building. And yes, so that's how I'm risk managing when this is a penny stock. And now we're gonna look at their PE ratios. Okay, so this is another, in a sense, the bull points about this. So this company is trading at a pretty high price to earnings ratio. Okay, 65 and forward PE of 41. Okay, honestly, what do you want to look for? If ideally, right, it's around 20. Forward PE around 20, trailing PE around 20 plus. Okay, over 30 is getting a little bit expensive. So and price to sales 9. Okay, a little bit expensive as well. But honestly, okay, if it's under 10, it's barely manageable. Okay, I'll look at under 10. So it's barely under 10. So it's on a little bit more of the expensive side. Pardon me. Okay, and yes, now let's talk about, okay, why even after all of this, I'm still looking at it. So you need to stay with me on this, okay? It's the numbers that really wow me, okay? And honestly, I'm looking at this as a growth play, okay? What is a growth play? Growth play, that means we might be paying a little bit of premium. That means in terms of, price to earnings, price to sales, we are paying a little bit more. But however, this premium is justified because its growth will be massive in the coming years, okay? It's a little bit like Amazon, okay? A bit like Microsoft, okay? All the bigger names, right? We are paying more for them. Shopify, okay, price to earnings is like 100, okay, 100. Okay, we are paying a premium for it because they have massive growth in the future. Okay, value plays are a bit different. Value plays are, Warren Buffett style, where we find really good companies, right? They have a decent growth and decent sales. Okay, it doesn't mean they have to grow massively in the future, but they have this decent business going along, and we buy them at a huge discount. Okay, so this is a different thing. Okay, we are buying at a discount. Growth plays, we are buying at a premium, but to justify its future massive growth ahead. Okay, so since it is a growth play, right? Okay, it is going to be a bit more expensive, and that in a sense justify why the PE ratio is so huge. And this company, okay, I know I've been tickling your you guys, leading you guys by the nose for a little bit, but this company is actually Zyntech Medical. Okay, and its ticker symbol is ZYXI. Okay, and this is the company itself, ZYXI over here. There it is. Okay, this company over here. Okay, although it's not under $5. Okay, so I'm also a bit unsure whether to name it as a penny stock, so I just call it a small cap stock. Okay, and yes, this is the company. Okay, ZYXI ticker. And okay, so what happened? Okay, so this stock was up over 71% in the past 12 months. Okay, it has dropped 25% in the last 3 months, and because its third earnings, right, was missed by 23%, okay, which is quite a little bit steep drop, okay, and yes, so it dropped quite a little bit, and as you can see over in the charts over here, right, its all-time highs was around, okay, $30, and it dropped all the way down to, actually quite a steep drop to around $15, and it recently has rebounded a little bit, okay, and yes, that's what really happened, okay, but honestly, it's because of the RONI, okay, the RONI was there, okay, the RONI was helped, force them to lower their sales, okay, lower their EPS, and honestly, that's why it created a dump. And then honestly, I was a little bit happy that this happened because it gives us a buying opportunity. Okay, and what am I really excited about? This is the part, okay, this is the fundamental aspect. Okay, Zyntech announces 117% year-over-year growth and increased adjusted EBITDA estimate. Okay, wow. Okay, even in this pandemic, okay, taking into account this pandemic, right, they are announcing 100% plus order growth for their products. Insane, okay, and if you're wondering what their products are, right, okay, let me take a look at their products, okay, let me read to you, okay, so Zyntech, right, through its subsidiaries, they design, manufacture, and markets medical devices to treat chronic and acute pain, and activate and exercise muscles for rehabilitative purposes with electrical stimulation. It offers next wave, a dual channel, multi-modality inferential current, and TENS. Okay, so basically they use electrical stuff to stimulate the nerves and everything, okay, to create some kind of shock wave within the body, so that it treats your pain, it treats the acute pain, and it's like kind of like an electrotherapy kind of thing. So yeah, so in a sense, they also supply electrodes for the delivery of electric current, okay, and the batteries for use in therapy products. Okay, and yes, they have quite a few of these things, right? And they have a few products for pain management as well as stroke, spinal cord injury rehabilitation. This company later they also secured a patent for a different product altogether, and I'll get into it a little bit later. Okay, so but basically this is what it does, and yeah. Okay, so again, go back to the numbers, right? Okay, they are having strong very, very strong EPS. Okay, as you can see, EPS next year 75%. Okay, EPS past 5 years 27% growth. Okay, year over year. Wow. Okay, very consistent growth right there. Okay, sales. This is the most exciting part for me. Sales quarter over quarter 69% increase. That's insane. Okay, that's really, really insane. Okay, that's a huge amount of sales that's coming in. Okay, especially this quarter. This was a horrible quarter. Okay, and you can see, oh no, EPS minus 37%. Okay, honestly, let me just I did a little bit of more deeper research into that, and I'll explain to you why it was 37%. Okay, but most of the time, what does this mean? Why is this such a huge discrepancy between sales and EPS? That means most probably they are spending a lot of money on some other stuff. Okay, but their sales or their top line is very, very solid. Okay. Insane growth. If you do a discounted cash flow model on this, right? If they can maintain a 70% growth, okay, not even 70% growth, a 40% sales growth quarter over quarter, their stock price in the next few years easily $100. Okay, if they can maintain, this kind of strong growth ahead, and especially if they are able to control their overhead costs. And what happens? Why did this happen? Why did they have this low, high cost that's coming in? Okay, so basically, right, as clinics remain shut down during the COVID-19 pandemic, the company increased its sales force headcount drastically and drove up marketing costs to maintain revenue growth. So this strategy seems like a temporary fix, and sales and marketing costs should go down as clinics resume normal operations. So in a sense, they're doing their marketing, and the marketing is working. So because they're driving up their sales, and they're just increasing, the short-term kind of cost to increase their long-term profit. And I like this kind of companies which are able to think ahead instead of just try to preserve, and go on preservation mode, cutting everything and not really spending money to increase our revenue, just trying to survive. Okay, those kind of companies, not really growth companies. Okay, maximum they are maybe a value play, but not really a growth company. Okay, so growth company wise, this is what I want to see. Yes, and another thing that I'm excited about is the gross margin. Okay, gross margin is basically the cost of the goods itself, right? Okay, and the revenue from that goods minus the cost of the goods itself, it will become the gross margin. And the gross margin from 2016 and 2020 has been fluctuating quite a little bit, but recent years from 2018 to 2020 has been fluctuating and stabilizing or consolidating, okay, around the 80% level. Wow, 80% gross margin. That means for every $1, right, of product that they sell, right, they keep 80% because 20% is actually the cost. Wow, insane. Okay, and you can see the gross margin is 78% and their profit margin is 14%. 14% is also pretty good actually. So what's the difference between gross and profit? Okay, gross and profit, right? Basically, gross profit margin is calculated by deducting the revenue, the cost associated with the product, such as parts and packaging. But a net profit margin is the bottom line in percentage terms and ultimate measurability or probability of a company. Okay, so basically, let me just break it down in simple terms, right? Okay, let me go back one slide. Okay, so gross margin, right, 78%. This is the cost of creating the good itself, which is the manufacturing, all the devices and everything, and the revenue minus the cost of creating the good. Profit margin is adding all the advertising costs, adding all the other overhead costs, all the other expenses. Okay, as I said, why is their profit margin so low right now? Because they are increasing a lot of their advertising, their marketing and everything, and that's why it drove their profit margins low. But even so, 14% is also decent, especially taking into account after all the advertising costs. So yes, and next point I'm going to talk about. Okay, after all, it's huge, massive growth, right, that I've been seeing in this company, right? This massive growth that's and the numbers behind all its sales, right? What I like to see is, okay, besides having the sales, you need the market to sell to, okay? And you want to see this total addressable market or the market that they're selling to be growing in the next few years. And what I like about this company is it is similar to a company that I really, really love, which is Teladoc Health. And Teladoc Health, right, is a company that is disrupting, the current healthcare industry, which I already have a position in, okay? And I bought a lot of Teladoc when it was at $184. I was like, anything under $200 was a steal. I loaded up massively on my portfolio, okay? And now it's up it's at $270. So I'm a good 40% up on this company. So this company, very, very great long-term wise, right? But it has already run up quite a little bit. But this company ZYXI hasn't really been running up yet, so good thing. And both these companies are disrupting the industry. Okay, so you can see that this company, right, it sells management devices for pain management. Okay, and there's this company called Zx, right, small cap research. Okay, they also thought that, they created a paper that says that, this company actually disrupts, is a huge disruption to the current industry of management. Because what they do is, they now take a lot of account into home-based chronic treatment, which you can see from over here. Okay, they're expanding into the patient monitoring market. Okay, a 5 billion plus global opportunity. Okay, this they sell pulse oximeters which can have a delay. That is quite expensive, inexpensive, and there's a delay for unstable patients. But there's increased demand for the move to continuous and non-invasive monitoring of patient vitals. Okay, and this company is actually going towards that. And they set the global market for vital signs monitoring at $5 billion to $9 billion, and a potential $15 billion market in 2026. And you can see that Teladoc has already acquired Livongo, right? If you don't know who Livongo is also a company which does patient monitoring, and it's quite similar to XYZI, but XYZI is a very, very small scale. Okay, Livongo is a much more huger company that is existing in the space, but they're going after the same opportunity, which I really, really love, and it's really in line with my beliefs that this is actually the next big thing. Okay, and let me just put on the last one, which is the Zintex announces the filing of patent for sepsis monitor. Okay, this is the one that I was talking about. Okay, they also have patent for sepsis monitor. Okay, I had a little bit of a health background last time. Okay, I was a medic last time. Okay, a huge medic and massive medic. Okay, a massive medic, and I did a lot of medical care and everything. And sepsis really is one of the largest, death occurring kind of not really a disease, but it is something that happens that causes death quite quickly if not being noticed by the doctors and the nurses. Okay, and this kind of things happens pretty fast. And with continuous patient monitoring, right, this actually increases the patient's life of survival. Okay, and this is really, really important. Okay, sepsis is one of the biggest problems in hospitals today. Okay, over 1.7 million adults develop sepsis, with nearly 270,000 deaths in total. So really important problem. They're solving a good problem. I like it. Okay, so yes, that's for all the fundamental aspect. Okay, that's how I mean by doing very, very deep due diligence into a company. Okay, and honestly, there's still more to this company. Okay, but if I delve more into it, it'll be like a 30-40 minute video. Okay, now let's look at these technicals. Okay, technicals, right? You can see a very, very nice little reversal over here. Okay, after all the bad shit that's happened, right? They have broke down to a low of $14. Okay, and they have consolidated a little bit, popped up, reversed, popped up, reversed. Okay, I added quite a bit at $18 and $18.50. Okay, I'm still building my position. I haven't built fully my position yet because I wasn't really sure about this, because I can see that they might actually retract back to the 20 moving average. Okay, so I'm still building my position over here as a long-term investment, but probably it'll be around maximum 4% of my entire portfolio, because it is a penny stock. So I do want to take account, that some things could go wrong with this kind of very small market caps, and it could be easily manipulated by by the bigger hedge funds and everything. So I will not be exposing too much of my portfolio into this, but I'll be slowly building into it, as they have better news, they have better sales, they have better stuff, and they graduated, to becoming a small cap company. Okay, and so yes, technical wise, okay, if you really want to do this as a swing trade, right? But I'm talking to you as a long-term fundamental play. Okay, swing trade wise, okay, let me bring up my doodle. If you really want to, okay, you can see that it has a very, very nice, stair-stepping ascending triangle pattern. Okay, it's a trending pattern. Okay, it probably will go like this, right? Okay, and you can see that right now it's at this point. Okay, this point is where the pullback is at. Okay, if everything goes well as per normal, right, you probably will go up to its all-time highs before pulling back again, and all-time highs before pulling back again. That's what it would normally do, right? But however, one thing is I don't really like is technical aspect wise, right? You can see that there's a big red candles over here, which is a huge drawback. Okay, as I said, this kind of turnaround place, right, where it's a higher high, a lower low, lower high. Okay, then after it starts breaking up, from a lower high to a higher high, right? Okay, what I want to see is this area. Okay, the pullback is very, very small candles. Okay, very, very small candles. That means the buyers, right, are in control now. The sellers have trouble, pushing this price down. Okay, but however, you can see there's still big red fat candles that is, covering this area. But what I do like is, okay, yesterday it was 7% up. Okay, there's a huge buying pressure that is coming up right here. So honestly, at this point, okay, as a trade it's okay, it's all right. Okay, but I think at this price point, quite decent to start a position in. Okay, and that's it, for today's video. I really hope you guys liked today's video. Okay, it was a very, very long video, and yeah, to wrap it all up, right, I have one more slide. Okay, which is short flip, 32%. Okay, we know what short float does, right? Okay, short squeeze, okay? But that's also mean, okay, there's a bad side of having a big short float. That means there are always constant people pressing down on the price, a lot of short selling pressure on the price. So it's going to be super volatile, up and down, up and down, up and down. So if you can't really handle this kind of volatility, then maybe these kind of small cap stocks are not really for you. Okay, yes, okay, yeah, and again, okay, let me wrap it out, recap. Okay, so this company is a small cap, a growth stock, and I really, really love this company as a growth play, and I will be building my positions into this company because, as I said, this company is in line with my beliefs, and I really firmly believe in this company's fundamentals, and they have very strong numbers to back it up. Okay, only when you've done your due diligence and you have these strong numbers, right, that backs up your belief, then you're able to go heavily into a company. Okay, $10,000, $20,000, $30,000, $40,000. Okay, will you be able to sleep nicely at night, knowing that you never do your due diligence and you're putting so much money on the line based on someone else's opinion? No, right? So you need to do your own due diligence. You really, really need to do your own due diligence on this. And I hope even if you don't buy this company, right? Okay, if you don't agree or anything, okay, you can use this as a framework, for your future due diligence and do your own companies, and you find companies that you really, really like and have strong fundamentals and go for it. Dollar cost average, and hold for the long term. And that's how we do for fundamental companies. Okay, a play on fundamental companies, a play on long-term play. Okay, short-term swing trades, totally different story. Okay, which I do every single week. Okay, but yeah, that's it for today's video. I really hope you guys enjoyed today's long video. Okay, smash the thumbs up button. Okay, subscribe to this channel if you like this kind of content. Okay, and you appreciate all the blood, sweat, and tears that I put into this nice little slideshow over here. And I shall see you in the next video. Stock stay out.